The original purpose of these deductions is mainly cost recovery, just like any other industry. One of the deductions is our ability to deduct our drilling costs. It's been around since the early 1900s. That's just like the R&D deduction for any other industry. It's cost recovery with respect to timing. One of the other deductions we get, Section 199, that was created in the American Jobs Act of 2004 to create and promote domestic job growth. So when we say repealing things like the Section 199 domestic manufacturers deduction, which everyone gets, you get it at a 9% rate. We're penalized at a 6% rate. So repealing that for us, plus these drilling cost deductions, would compromise about 600,000 barrels of oil equivalent per day. And that's a loss of about $15 billion in capital in year one. So you're talking serious economic hit to our economy at a time when the energy sector is responsible for driving the recovery. And so these policies, this vindictive use of the tax code to just target one industry because it's politically unpopular over another is just simply a terrible idea. If we're looking for revenue, and since we are talking about energy policy here, there's one really easy thing we can do to bring in revenue, and that's increase access. In the current restrictive environment, this isn't exaggerating, we're paying $87 million every single day to the federal treasury. No one pays more than us every day. If you increase access over a 20-year period, we could contribute an additional $145 billion, or 140 something, I don't know the exact number, billion dollars to the federal government. If you raise taxes as the Obama administration proposes, sure, you'll get a little bit of revenue in the short term, but in that same 20-year period, you'll decrease government revenue by about $100 billion. And that decrease comes from decreased economic access on the energy front here in the U.S. So when the president talks about investing in innovation and wanting to raise revenue and things like that, we completely agree with him. And we're right here ready to do that.